Good evening, everybody. Thank you very much for joining, and thank you, Mark, for the introduction. I'll share my screen. It should work seamlessly. Hey, I think everybody can see this. So to introduce myself, I'm Richard Hickman. I am Managing Director at HarbourVest in London. My role is to manage the listed investment company that we offer to public market investors. It is the only listed fund or company that HarbourVest manages. We've been listed now since December 2007, initially on Euronext Amsterdam, but since 2010 we've been listed in London, initially there as part of the specialist fund segment, but since 2015 we've been main market listed and a member of the FTSE 250 index. So to set the scene for those of you who are not shareholders who may not have seen me present before, HVPE is a private equity investment company. So our portfolio is substantially all private companies. We have $3.9 billion of assets in total, having grown organically from the $800 million of assets that we started with back in December 2007. So we've effectively multiplied our opening assets by more than 5 times. When you also bear in mind we've paid out $200 million to shareholders along the way. That growth is entirely driven, or was entirely driven by the investment return. We have not raised any additional external capital since the IPO. So a very strong result given the IPO, as I'm sure many of you remember, December 2007 was not the most fortuitous moment in global markets, and so we started from really the peak of a prior cycle. We have more than 1,000 material private company investments in our portfolio. We're a global fund. We are striving to build and have built a very broadly diversified range of investments across geography, strategy, and investment stage, and I'll talk you through those stages as we go through. But the essential point about HVPE is that we are the most diversified listed private equity investment company. So we strive, of course, to deliver very consistent annual growth in net asset value, and we believe a diversified portfolio is the best way to achieve that. I mentioned we joined the FTSE 250 back in 2015, initially as you'd expect, the lowest ranking member, but we've climbed up to number 53 as of the end of February with a market cap of £2 billion. This makes us one of the largest listed private equity investment companies and also one of the most liquid. So we tend to trade quite well, about £5 million of stock per day as a typical baseline level, and sometimes more. So that does allow the vast majority of investors to manage their positions easily. We do have a mix of investors. I'm pleased to say 16% of our shareholders are retail investors who hold directly through the platforms, but we also have 40% of shareholders being wealth managers. So again, underlying clients represented by those wealth managers. And we also have institutions, family offices, and a whole range of others. So very broadly held, a very mature shareholder register. Those who have been invested for a while now, for 10 years, will have seen a strong result. So gains of 227% in the sterling share price over that 10-year period. That has been driven, of course, by the underlying assets having performed. So in the middle box here at the bottom, 13% per annum is the compound annual NAV per share growth rate in US dollars over that 10-year period. And that 13% represents an outperformance of 2.7% per annum versus the public markets as measured by the FTSE All World Total Return Index, so a global index with dividends reinvested. And of course, our performance figures are all fully net of fees and costs. I should add that 2.7% is, while that's of course still material outperformance, in previous periods that rolling 10-year figure has been higher. It's trended towards the 3 to 5% range, and often is around the 5% level. So that's really where investors tend to target the returns that they want to achieve from private markets, that 3 to 5% per annum. So a few words on the board and the team. We have a fully independent board, 5 directors with no connection to HarbourVest, the investment manager, and drawn from both the public and the private markets. Some of you may know Ed Warner from his role on what is now Patria Private Equity. So he was chair of another listed PE fund for nearly 10 years. I won't step through every name, but a good range of experience across, as I said, public and private markets. We also have a dedicated investment committee within HarbourVest just for HVPE. So you see, I sit on that committee alongside the CEO of HarbourVest, John Toomey, the CIO, the Chief Investment Officer, Greg Stento, and Carolina Espinal, who's the head of European primary investing. So all 3 of those individuals clearly very much at the coalface in terms of running the firm and liaising with clients and making investment decisions. My team is dedicated to HVPE as a listed fund. So all the faces you see on the bottom row across the London and the Boston office are fully 100% allocated to HVPE, and they help me to manage the fund and the company through all aspects, including operations, reporting, investor relations, and governance. I would add as well, in addition to the individuals you see on this slide, if you look at the top right-hand section, there are actually more than 245 investment professionals within HarbourVest globally that are dedicated to running the underlying investments that we have as a listed investment company. So there's an extremely broad and deep pool of talent in the firm dedicated to running the assets. And in turn, I'll explain the structure for those of you who are not familiar as we go. But in turn, the HarbourVest funds are investing in funds managed by third parties, and there are 650 of those managers. So we are really the polar opposite of a typical star individual fund manager-led portfolio. Each tiny sub-segment of our portfolio is managed by a dedicated specialist, either in HarbourVest or at the underlying manager level. So a few words about HarbourVest itself. It's a well-known firm generally in private markets, but I appreciate those of you who are coming to this fresh may not have heard of the firm. We are regarded as a blue chip manager globally, but particularly in the US, where the firm originated. So the firm has been operating for well over 40 years as a specialist in private markets. We don't do anything else as a firm. There's no public equity division. It's all private markets oriented. And we have a team of managing directors across the firm who have an average tenure with us of 13 years and actually an average industry experience of more than 20 years. So again, very, very broad and deep pool of talent dedicated to the fund. We have 14 offices around the world across the US, Europe, and Asia. The AUM for HarbourVest overall, the assets under management figure, is $138 billion. So we're a large-scale operation. The listed fund, as I said, is just under $4 billion of assets. So we're a significant portion of AUM, but the majority of the firm's activity is traditional private markets investing through private structures. We have what we consider to be a leading position in the industry, particularly when it comes to relationships with GPs, i.e. the underlying managers that we invest with. So we have advisory board seats across 950 underlying funds, and that's where we are able to feed in our views as a firm the way that that manager is managing the assets, and hopefully make helpful suggestions if needed. And we have expertise across what we call primary, secondary, and direct co-investments, but also credit and real assets. So the latter two being more recent additions to the firm's skill set. But we've been investing in primary, secondary, and co-invest for more than 30 years, and still even with the newer strategies, more than a decade in each of those. I'll move on to HVPE's portfolio. Apologies. So this shows you the top-down allocation that we have in terms of stage, strategy, and geography. Now we have targets for each of these at the top of the slide, shown by the ring charts. The targets are in grey to the right-hand side of the actual figures as a percentage of current NAV. So we have the largest single exposure starting on the left-hand side to buyout investments. So those are investments where effectively the private equity manager takes ownership of a private company. They take a control stake, more than 50% of the equity, and typically much more than that. And they will then drive development of the business. So they will, if necessary, they'll change senior management. They will initiate new targets or projects that they believe would be helpful to the firm. There'll be a value creation plan that's set out upon investment that is followed rigorously over typically 3 to 5 years. And so those investments tend to be in the more mature companies in our portfolio. So they can be relatively small, but they tend to have been well established, sometimes family businesses, sometimes they're corporate divisions that have carved out of a larger corporation. There are lots of situations, but they tend to be profitable companies. We tend to focus on the mid and small cap end of the buyout market, which historically has performed well for us. We do have some large buyout exposure selectively, around 15% of NAV, but the majority of that 62% is the small and mid cap focus. We also have venture and growth equity. So these are funds that typically take minority stakes at an earlier stage, even as early as the seed stage, as we call it, where a business is just being started up and requires capital to effectively get up and running. But we also have later stage venture, which, as the name suggests, it's funding rounds that perhaps are several years into the development of the company when it's starting to really gain traction. And we also have growth equity. Those businesses tend to be relatively new businesses, but emerging as profitable enterprises. And so there's a little bit more certainty over that portfolio. But the venture and growth equity side, with 30% of NAV, it does give us something of a unique selling point in certainly in the fund of fund space. And it has helped drive strong returns. Despite the well-publicized weakness in the venture and growth equity space in the last couple of years, over 5 years, it has still outperformed the buyout exposure. So we do believe in the importance of having that mix of assets. And then finally, in the stage category, private credit and infrastructure, those assets are focused more on yielding types of returns, so a cash yield or a rolled up payment in kind return, but more predictable, less volatile generally than the venture and growth equity assets. So they act as somewhat of a hedge really against the volatility that we have from that part of the portfolio. If we move to strategy, we have primary fund of funds investments. So that is where HVPE, as a listed investment company, makes a commitment to a HarbourVest primary fund of funds vehicle. That HarbourVest fund of funds vehicle then in turn makes commitments to funds raised by third-party specialist managers. So we might have, for example, the better known names you may have heard of, KKR or Carlyle or Bain Capital on the buyout side, Index Ventures, Accel Partners, Andreessen Horowitz on the venture side. those managers raise funds regularly. Our HarbourVest primary fund of funds vehicles invest at the inception of those funds. And in that way, we guarantee exposure to some of the real top performing managers in the industry. The key benefit there, I would say, is that as a shareholder in HVPE, you are tapping into a privileged network that has been established by HarbourVest over a 40-year period. We have access to some of those real blue chip names, the top performers in their respective segments in venture and buyout disciplines. So roughly half of our portfolio is dedicated to that steady, predictable fund investing strategy. 30% is focused on purchasing some of those same funds at a more mature stage in their life. So a HarbourVest secondary fund vehicle will purchase portfolios of companies still managed by third parties, but with a view to driving value as an owner. And also, we tend to acquire many of those funds, many of those portfolios at a discount to net asset value as well. And finally, the direct co-investment portfolio, that's more akin to what you might imagine is a standard private equity approach. That is where a HarbourVest fund will invest directly into operating companies as a minority investor alongside what we call a lead sponsor. So it might be KKR making an investment in a specific business, and they invite HarbourVest to partner with them in that investment. So that's 20% of NAV, and really gives us a little bit more control over the individual companies that are added to the portfolio. Finally, by geography, we are not too far away from the FTSE All World Total Return Index allocation by geography. The only major differences really that are worth pointing to are the fact that actually we're underweight the US at the moment relative to public markets, given the very strong performance of the Magnificent Seven, which themselves are now 20% of the FTSE All World Total Return by value. So we're at 61%, we do believe clearly we have significant exposure. We do not plan to increase that in the near term. Europe, we have 22%. That region, contrary to popular opinion, I guess, has actually performed very strongly in terms of the small and mid-cap private companies space. So we've seen that Europe in our portfolio has outperformed North America over the last 2 years. And so again, arguing for that diversification that we believe is so important. And then we have Asia Pacific at 15%. We have brought that down slightly in the last few years, certainly versus the target level, which has come down to 16%. And the rationale there is, frankly, we've seen a reduction in deal flow from China in the last 3 to 4 years, I would say. That's been a bit of a challenge for us in terms of maintaining exposure, because China has been a dominant component of the Asia Pacific region, as you'd imagine. But we are seeing growth in other Asian countries. So India, notably, is growing very well, and the private markets ecosystem is developing quite rapidly in India. And we did see a bit of a burst in Japan in 2023, although that came off last year. But we do think there may be a longer term trend to increase the penetration of private equity into Japan. So that's an area many of our managers are keen on. But overall, the message is, we are trying to deliver balanced exposures to maximize the opportunity for outperformance and to offer really public market investors something that they can rely on as a source of genuine global exposure, which sometimes is difficult to achieve. By industry, we have again a well diversified portfolio. You'll notice immediately the overweight position in technology and software, which is driven by the venture and growth equity allocation. We believe that is an entirely sensible allocation in the world as we see it today. The potential for outperformance in some of these companies is really exciting to us, and so that's something we just want to highlight for investors that is a feature of HVPE. But alongside that, we have some perhaps steadier type of sector exposures, such as consumer, some financial exposure, and also industrial and business services. So there's, again, a broad range. We try to build a portfolio that has very limited internal correlation. So we're trying to select businesses that will perform differently at different times, within the same kind of macro environment, again, to deliver that steadier return. I'll step through the top 10 companies. Before I do, one feature of our portfolio, because we're so well diversified, it's actually quite hard for us to talk meaningfully about individual positions in many cases. You can see from the investment value column, the percentage of NAV is relatively small, even in the top 10, 7.5% in aggregate. We do have one relatively large single company position, which is Shein. You may know that is fundamentally a China-based fast fashion business, although it's now headquartered in Singapore. Most of its manufacturing is in China, and it essentially delivers clothing and other items directly to the consumer from the producer. So they operate a very efficient model, a tech-driven model as well through the app, and so they've become very well known. The investment has grown in value very substantially since we purchased our investment in Shein as part of a secondary fund of funds portfolio. So it was one of many companies that we gained exposure to several years ago that's actually grown disproportionately. So it's become our largest holding organically. That company may be about to IPO. They're pursuing a UK listing at the moment. I won't step through all of the names here. You'll perhaps recognize Action, the Dutch retailer, although it's now pan-European. It's a discount retailer along the lines of Aldi and Lidl, but with no food. So imagine the middle aisle of one of those chains where they have a mix of different items on a rotating basis. That's the whole store, and they've done extremely well. It's actually 3i's most successful investment, and I believe one of, if not the most successful buyout investment in the European private equity industry. So very, very strong result. We invested several years ago as part of a syndication. We also have Froneri, which is a Yorkshire-based food business focusing on desserts. And that is, very much a solid consumer business and producing food. Much less volatile in these troubled times, perhaps. We also have Revolut. You definitely have heard of that. It's a leading fintech company. At the end of 2024, it gained a banking license and also went through effectively a private liquidity event for founders and employees, which valued the business at $45 billion. So I think one of the largest, again, venture companies in Europe. And a couple of new entrants worth pointing to, or relatively new. Databricks is a company that manages enterprise-level data for businesses, and it's operating now as well with an AI-driven model to help serve clients better. So that is an AI-related business which just saw a very successful funding round, which increased its valuation quite substantially. Hence, it's in our top 10. And just second from bottom there, Scale AI is another new entrant. That business specializes in supplying the databases on which large language AI models are trained. So almost a picks and shovels play on AI, which again is growing rapidly. So I hope I focused on perhaps the more attention-grabbing names in the top 10, but you'll see there's a very good mix of companies here, very limited correlation in terms of any single event, impacting these companies. Turning to a favorite topic of any investment trust commentator or market participant, the discount to NAV. This chart shows it very clearly because we're showing here the net asset value per share from one financial year to the next, and you can see the progression steadily over time. But also the share price in green, and you'll see immediately that the gap between that green line and the top of each bar has really widened out. It really started in the COVID crisis, but it's been persistent since then, as we've seen one shock to the system after another. Of course, the most significant perhaps being the interest rate rises in early 2022, but also now some instability geopolitically again. So it has been a challenging time for investment companies as a whole, as a sector. Listed private equity is not immune from that. Has its own challenges as well in terms of the cost disclosure regime, for example. I won't be able to list everything here, but we have had a tough couple of years. But I strongly believe there is latent value in our portfolio. The net asset value has continued, as you can see, to grow steadily, albeit at a slower pace than pre-COVID. And really, I think that's been a period of consolidation as the industry adapts to this new environment that we're in. We are optimistic for 2025. We do think that portfolio liquidity will increase. And generally speaking, when we have more liquidity, we have more uplifts to carrying value when those underlying companies are sold for a profit, and that can generate additional growth in the NAV per share. So I'll talk to that later in the presentation, but that's just to give you a bit of a hint there. We're currently at a 35% discount, and we have announced initiatives to try and address that, which I'll cover very shortly. Okay, so on the 30th of January, we announced a three-pronged approach to enhancing shareholder returns and clearly striving to narrow that discount. So the first and most important one, I think, for new investors to be aware of, is that we have now what we're calling a distribution pool mechanism. That was introduced on the 1st of February 2024. Since when we've allocated a very significant amount of capital to a pool that is designed to be deployed in the interests of shareholders. So it's under the control of the independent board. They make a decision on a regular basis as to how that capital is deployed. But since the pool was set up in 2024, we've seen that pool deployed only into share buybacks. The rationale there is that clearly at a large discount to net asset value, buying back the company's own shares and then cancelling those shares effectively is accretive to net asset value per share for remaining investors. So you have a more concentrated holding in the portfolio without having had to make any further investment yourself. So that's generally well received by shareholders and by the analysts. So on the 30th of January this year, just coming up to that anniversary of the distribution pool, we announced we would double the allocation. So previously, we were setting aside 15% of all the cash coming in from maturing investments, those investments being sold. 15% of that total, we're doubling it to 30%. We also, as part of the announcement, provided a forecast for the total distributions we expect for the year. And therefore, we've calculated the estimated contribution to the pool and hence the firepower likely to be available for buybacks, which I'll talk to on the next page. But I think so far, we're encouraged by how this has been received by the market. I think analysts have been, very enthusiastic, as have shareholders, and it does appear to have helped the share price. So not only through that accretion in NAV per share, but also I think through the sentiment that it helps foster in the market that we are confident that the shares offer very good value at the moment. And also, of course, it helps demand, all else being equal, helps the balance between supply and demand for the shares. So since we introduced this distribution pool, the share price is up by nearly 20%, while the net asset value is up by just under 6%. So you can see there's been a real benefit, we think, from that policy. We also announced the second point on this slide. The investment structure is to be simplified. You will have sat through my attempt at explaining our structure very concisely, but it is complicated. Going forward, we're simplifying it so that we, instead of investing in multiple HarbourVest funds, we instead have a separate managed account, so that HarbourVest will effectively tailor a portfolio to us as a listed company. Initially, our intention is to effectively try to mirror the types of exposure that we've had up to now, because that's been a very successful approach. We'll retain first in line access to deals where we are not being deprioritized by having a separate account. We will still invest with the same kind of priority as the fund of funds vehicles. But it'll enable the company, the investment company, to be more nimble in terms of deploying capital when perhaps we have a surplus cash, for example. And the mirror image of that, when we have a net drawn position on our credit line like we do today, it will make it easier to sell assets in the secondary market if that's what we decide to do. So I'll give a little bit more detail. Appreciate we have limited time, but perhaps it'll come up in the Q&A as well. And thirdly, we announced a continuation vote to be held not this year, but next year at the AGM. So in just under 18 months' time, we'll hold a vote. It'll be an ordinary resolution, a vote to continue. So there'll be a yes will mean please continue, a no will mean please discontinue. A simple ordinary resolution with a 50% majority of those who turn out to vote. So that really offers shareholders, I think, a really important milestone to look ahead to. It gives us time to roll out the initiatives that I've just described, and hopefully, shareholders will see more of a benefit as the year rolls through. But if for some reason we're in a weak position, if the discount has widened, then there is that opportunity for shareholders to express their view, and I think hopefully that will help to place a floor under the discount if, heaven forbid, we do go into another negative period for public markets. So stepping through those in a little bit more detail, I am conscious of time. I'll try to do this fairly quickly. This slide gives you a full account of how we have managed the distribution pool since it was introduced in February 2024. So you can see we rolled in $12 million from an existing buyback program. That $12 million was unspent on the 1st of February, so that was rolled in. We also seeded the pool with 3 separate tranches totaling $75 million over the year. That came from a fund commitment that we effectively decided not to proceed with. So instead of investing in a fund that would have called capital, instead that capital was allocated to essentially the share buybacks. The 15% allocation that was the standard rate that we started with resulted in $57 million being added. So you can see quite substantial amounts over the year. Buybacks of 106 million took the balance down to 37 million as of the end of January. And we are forecasting, now on the right-hand side of the chart, 30% of our incoming cash will be allocated, which is $183 million, in addition to that 37 million that's already in the pool. So very material potential firepower for this year. It would represent, if that comes through and it's all used for share buybacks, that would represent a very material uptick in pacing on a year-by-year basis. It would be equivalent to around 9% of market cap. And we believe that's a sector-leading allocation for the year ahead. So a quick run through of the structure. This chart illustrates quite clearly that the historic structure has been regarded as somewhat complex and difficult to communicate, particularly when addressing investors who may not have much experience in private equity to start with introducing all of these terms. So essentially, I won't spend too long on this, but we're moving to a much simpler structure, cutting out a layer, essentially. So HarbourVest, as the investment manager, will simply allocate HVP's capital on an annual basis, once approved by the board, to a mix of those primary, secondary, and direct co-investment opportunities that I described. So much more direct, much more controllable in terms of cash flow in both directions. And then the final point, the continuation vote here is illustrated as really the culmination of a corporate governance journey that we've been on as a listed company for the last few years. So we started off with a new head of corporate governance having been appointed. So that was shortly before Ed Warner became chair. We also began to conduct independent perception studies using a third-party consultant to speak to our larger shareholders and seek their views on key initiatives and how the company is being run. We moved to a fully independent board as of July last year, so that was a welcome move, I think, among some shareholders, and clearly provides that distance between the board and the manager that is definitely regarded as an important feature of investment companies in many cases. And we've continued with those perception studies most recently in October of 2024. And then we see that, as I said, the continuation vote really being the cherry on top of all this, giving that opportunity to shareholders, demonstrating our confidence, as a company, both from the board and the manager. We're so confident we do believe that shareholders will support us. We're striving as hard as we can to deliver those returns that investors expect. And now, conscious of time, so I'll bring it to a close here. Happy to take questions and happy to comment on the broader private equity market if that might be of interest as well. So over to you, Mark. I think you're leading the Q&A, I believe.
Yes, thanks very much, Richard. Very interesting presentation there. So just remind delegates, if you want to ask a question, just click the Q&A button, which you should find towards the bottom of your screen, and you can type your question into the box. So we've got a number of questions so far. So first of all, Simon is asking if you've analysed how the historic returns have come about. What proportion was from organic profit growth in the underlying companies? What came from multiple expansion and gains through M&A and leverage?
It's a great question. So thank you to Simon for that one. I should stress we have such a diverse portfolio. We have hundreds of underlying private equity managers, each creating value in their own way. For us, that has not been possible to produce an aggregate value attribution chart. What I would say, though, is that we probably are not too far away from industry averages. We do outperform the average private equity fund, but nonetheless, that will be informative. So I'm quoting from the Bain Capital Private Equity Report. Sorry, Bain Consulting, not Bain Capital. They produce a very useful industry-wide study every year, and they've been very straight about the historic return attribution in the industry. It's tended to be roughly half and half between multiple expansion and debt pay down. So the industry has tended to historically rely somewhat on that multiple expansion, but that, of course, in turn is driven by partly by the quality of the business. So private equity managers have intervened, improved the profitability of businesses, and that's helped the rating. We find that managers in the top quartile do deliver more value growth from a direct earnings growth result. So to the extent we're skewing towards those top performers, I would expect a significant component of our value attribution to be from earnings growth. And I think looking forward, that will become more of an important driver. The the top private equity managers are absolutely laser focused on operational improvement. They're rolling out all sorts of initiatives across their portfolios, and this is partly in response, being candid to the new environment we're in post interest rates rising to more normal levels. The industry is now much more focused on real operational improvement.
I guess there's quite a difference also between the buyout managers and venture. I would imagine with venture, growth is a much more significant component than with buyout, which is perhaps
Yes, that's right. That's right, Mark. I should have specified that the figures I was quoting were just for buyout managers.
Oh, that was only buyout, right?
Yeah. So venture managers, clearly they're not using leverage to anything like the level that buyout managers do, and in many cases there's no leverage. They are driving real organic growth in their portfolio companies, and in many venture portfolios, the fund return is driven by a relatively small proportion of those underlying companies that perform exceptionally well. One of the key reasons for HVP being so diversified is that we want to capture those right-hand tail performers to ensure that we're gaining the full return available from those funds.
Mm-hmm. Thanks. So David is asking about asking whether the board has considered a tender offer, which he suggests under the new structure, where, as you mentioned, it becomes possible to sell assets in the secondary market. Whether they might consider a tender offer as opposed to the continuation vote. So there'd be an opportunity for investors that want to exit at a value closer to NAV. Is this something that's been looked at?
I think the board evaluates options on a regular basis. We as a company take advice from our corporate brokers and from other advisors as well. I think at the moment the board is focused on buybacks as a means to support the price and to drive value through that NAV per share accretion. Tenders are clearly an option. I would say there are certain dynamics in the market that may drive a board to a tender versus buyback. If there's a known overhang of stock, for example, a tender might be a more efficient way of dealing with that, although clearly there's no ability to target a tender or a buyback at a given seller. But I think I would say it's hard for me to speak for the board, but I would say on their behalf that they would always consider every option, and I'm sure it'll be discussed regularly.
Thanks, Richard. Okay. Then Mike is asking, in addition to your institutional shareholders, are you planning to do perception studies with your retail shareholders?
It's a great question. We do try as best we can. So, we like to present through clearly, your platform here at ShareSoc. We also present through Investor Meet Company, which is a newer portal that allows companies to reach the retail audience. And as part of our Capital Markets Day, we often run a poll of the audience as well. So absolutely, we're always keen to hear from individual investors, and we often receive very valuable feedback. So please, if we include our email addresses on our RNS announcements and in our reporting. So please feel free, if you have an opinion you'd like to share, email me directly or Stephanie Hocking, our head of IR, and we'll certainly acknowledge that and respond where we can.
I just comment that I've attended, as you know, several of your Capital Markets Day, and they're very open. I'd advise anyone that's interested to sign up to communications on your website, and you should be informed about those and would have the opportunity to attend. And there's a lot of depth in those events. Okay. Then Murray asks, you mentioned that European private equity has outperformed the US in the last 2 years. I think, was that venture specifically?
That
If
was
so,
actually across venture and buyouts in our portfolio, so
both,
just by
right.
region. Yeah.
Mhm. And what do you think drove that, and how do you see the outlook going forward?
I think it was really a mix of genuine strength in Europe at the mid and small cap end. You know, investors are focused on the US because the large cap and mega cap public companies have outperformed recently. But actually, if you look further down to the small and mid cap, then Europe is more on a par with the US and in private markets because perhaps the industry is less well developed in Europe. There are more opportunities to add value. So I think that's part of it. Also, more of our more of our venture exposure is in the US, so that's been a drag over the last couple of years, just on the venture side in general. But increasingly we're seeing venture penetrate Europe as well. So it's I pull out that stat not really to necessarily emphasize that I believe Europe is a stronger performer going forward or likely to be stronger going forward. It's more just to illustrate the wisdom of diversification. When everybody is sure of something, it may may quickly cease to be true, if that makes sense. And so it's better
Generally
to
a contrary signal, yes.
yeah.
Yeah, so it's quite amusing how, at the start of the year, everyone was saying, oh, you've got to be invested in the US, forget about other regions, and look what's happened since. There we
Yeah.
go. Thanks. Then Mark is asking, can you say a little more about what you got from the perception studies?
Yes, yeah, great question. So we took the opportunity in the October study to really gain a fresh perspective from shareholders across a whole range of considerations. So across how they perceived the board to have responded to the market environment, for example, how they perceived the manager to have responded, and even as far as asking detailed questions about our presentations, communication approach, etc. So it's a very thorough, hour-long conversation that the consultant has with our shareholders. And so the feedback there was, definitely the positive. They'd seen an improvement. So we asked shareholders to rate us out of 10 across various categories, and the scores were definitely improving, and in many ways were strong to start with. There's a lot of faith in HarbourVest as manager. That there was some real kind of positive praise for the board as well. So more recently, following that formal exercise, we conducted a direct outreach program with our top shareholders just as the anniversary of the distribution pool approached, so through December and January. And their recommendations, clearly they vary from one shareholder to the next, but we were hearing, a lot of support for the distribution pool as a concept. The simplicity of it, the fact it's very visible, it's predictable. That every month we allocate that percentage of cash to the pool, and so they wanted to see that scaled up, and we responded by doubling the proportional allocation. So that was the main takeaway really that we've then implemented. But also the structure, we did have feedback that there was complexity there. It's difficult to communicate. A lot of our shareholders, of course, are wealth managers who then have to explain HVPE to their clients. So some of the feedback from them prompted us to move in the direction of a separate account. But yes, I mean, it was a very worthwhile exercise across that October study and the more recent outreach program.
Thanks. Okay, and I'll summarize Gordon's question. Essentially, as you've reported, HVPE has produced some very good results at the NAV level. Has the board given any consideration to combining with any other PE trusts to create a larger more efficient vehicle?
I wouldn't say it's something that we've considered in any depth. It's an extremely difficult thing to do in the investment company world. I would say, you know, the board would be open to suggestion if that were a possibility, if it could be demonstrated that it would add value. I know mergers are becoming slightly more common. They're still unusual, but there have been a few. So I think, you know, who knows where we are in a year or two, but at the moment, it's not something that's, you know, actively on the table.
No, I mean, I guess any alternative trust would have to have investments that were compatible with what HVPE invests in, which is not easy. It may become a little easier under the new structure, but where you have your own fund, but yeah, as you say, it's difficult.
Yes.
Okay. Now, a very good question from Satish, which we haven't really touched on so far, which is the principles that are used in the valuations of your assets. Can you say a little bit about how they're valued?
Yes, of course. This is a good question because it's a key concern among many investors in private markets. So clearly, you know, our portfolio companies, because they are private companies, they don't trade on an exchange. There's no daily price. So the manager of the portfolio in each individual case. So for example, you know, KKR might have a fund with 20 portfolio companies. They will value each of those companies typically on a quarterly basis. And in buyout funds, which I'll focus on here, the valuation of each business tends to be, not always, but tends to be based on an earnings multiple. So they'll take the earnings of that business, say it might be $10 million a year of EBITDA. They'll look at comparable public companies in a similar sector, similar size businesses, and they'll look at the average EBITDA multiple at which they are trading at that quarter end, and they'll use that to inform the valuation of the private company. It's normally not a direct read across because that is a large but not the only component in the valuation. There are often also precedent transactions that can be very valid and useful sources of guidance for the manager. So, for example, if a similar private business had been sold 6 months earlier for a 12 times EBITDA multiple, that is likely to be included as a factor in the valuation. In larger businesses with perhaps more predictable cash flow, more mature businesses, they will often use a discounted cash flow model, either on its own or as a complement to an earnings-based measure. And moving to venture and growth equity companies, they are harder to value, I would say, than the more mature buyout-backed companies. So they tend to be valued based on the latest funding round in the case of venture names, and potentially with growth equity, depending on the stage of development, it'll be a revenue multiple or an earnings multiple based valuation. So there's a mix in the portfolio. What I would stress is that the valuations are audited at the level of those general partners and at the HarbourVest fund level, and in turn, the listed company is audited. So there are many checks and balances there to ensure there's nothing untoward or unusual in the valuations. And historically, when we see underlying portfolio companies sold, they tend to sell at a premium to the carrying value, which suggests that the valuations have been conservative, certainly for the last 10, 12 years. Final point is, you may be surprised to hear that there's a consistent premium. Part of the reason is that there is often an illiquidity discount baked into the private valuation. So that's a further buffer really for investors where there's a bit of uncertainty. Perhaps it's a company that's not so easy to sell. Then that discount will be wider as well at the underlying level. And then, of course, you have the discount at which our shares are trading versus that published NAV.
Yeah, so investors have a further layer of insulation there with the discount of your shares. Okay, I think we've got time for one more question. That's it. So David is asking about DP Australia. He asked why Australia rather than India or another emerging market? Is it opportunity driven?
Exactly. That was part of a secondary portfolio that was purchased by one of our infrastructure funds. So it's DP World Australia, the ports business, second largest ports operator in Australia, and so it was purchased actually together with other transport related assets as one of the first deals in that infrastructure fund. So it was purely an assessment of the growth prospects for the company, the reliability of cash flow, the ability to push through inflation or rising interest rates through the revenue, and also the discount at which we were able to purchase those assets. So a whole range of considerations, but clearly an important part of the portfolio given it's in the top 10.
Okay, well, thanks very much, Richard. I think we're pretty much out of time now, so very much appreciate all of that. Good answers to the questions as well as your presentation. Thank you.
Okay. Thanks, Mark, and thanks everyone for joining.